Hi, everybody. Welcome to our Social Security Seminar for 2023. I'm Jolene Tenenty with AMAC Foundation. All right, how many have heard about AMAC before? We have a few people in the room. The sister organizations, we have AMAC Inc., we have AMAC Action, and then we are the AMAC Foundation. And AMAC Inc. is our membership services. AMAC Action, they take action on the legislative side, and then AMAC Foundation. We are the deliverer of information for you. The AMAC Foundation mission, we help to protect and ensure our senior citizens, our senior population. We like to inform, provide resources, educate, and disseminate as much as possible. So we keep you in the loop of what's going on. What do we do? Well, we have public seminars like this one. We work with organizations locally and help facilitate their informational resources, seminars, webinars, etc. We have our website and also Social Security report and Medicare report. Both are .org. We have information posted there daily. And then we also have our wonderful Social Security advisory services with accredited individuals that help you answer your Social Security questions. Our primary website, amacfoundation.org. You can find on here news. We have weekly updates. We have our veteran services. We have many resources for both seniors and veterans. Our Social Security advisor services are also listed on there. We have an events page, news feed, and then also some audios, videos. We have podcasts and recordings for you to peruse. There is a search button that you can put in topics and look for things. And our email, info@amacfoundation.org, that is also available. Maybe you guys have a topic in mind that we haven't explored yet. So always feel free to share what's in your best interest. So a little bit about the Social Security Advisory Service. It was launched in January 2016. We have 6 active accredited advisors that help people every day. We have many phone calls, emails that come in. People also communicate via Facebook or Instagram posts. When information is posted on there, we comment back. We also email and we'll call you back and interact. Our services provide individualized responses, and that is one of the key guides to understanding that our services are free, top-notch, and they stay up to date every day on what's going on to help everyone on their Social Security needs. To date, we have over 28,000 questions that we've handled. So a little bit about the service and some other things we do. I mentioned the Social Security report website that we have. Again, that's updated daily. We have people that post different trending news articles, what's going on up on Capitol Hill, who's fighting for what for you. This website was launched in early 2017 and continues to grow daily. Ask Rusty series, if anybody has heard, he's has radio clips. We have the news published, and you may have even seen things in local newspapers. His articles, we have Russell Glore here. He is Ask Rusty, and he also has some publications in print. We have books at the back of the room. You can find it on our website as well. He records podcasts too, and those could be found under the audios on our website. In addition to his information, we have a team who records Instant Academy, and they are short clips of information of some most frequently asked questions or topics that interest those and those that have questions on them. So what do we plan to cover today? Well, in general, Social Security. So some basics, when to file, that's a big question right now. People have many questions. Should I grab it at 62 or not? Taxation of your benefits, disability, spousal and survival benefits, then also the earnings test. Can I work? Can't I? How much am I making? Those questions will be answered. Then your COLA, cost of living adjustments. How does that affect you from year to year? We have WEP and GPO, who's affected by those, Medicare, and also Social Security solvency. So they will all be covered topics for you today. And in addition, don't forget to explore our website and find additional information on there. And always feel free to call and utilize our services. Thank you. Next up, we have Arlene Sharp, and she'll give you some of the basics.
Hi, my name is Arlene Sharp. I joined AMAC in 2013 as a member services representative. And then in 2019, I transferred over to the AMAC Foundation to become a Social Security advisor. So this is a synopsis of what's new in this year. The cost of living increase was substantial, 8.7%, which is very unusual. It's usually between 1.4 and 4%. And we did have 1 year back in 1980 where it was like 14%. But that's really highly unusual, and it's tied to inflation from the previous year. So when you do get a raise, it's kind of at a tough time. And also this is just figures for the different categories that increased this year. The maximum taxable earnings, the maximum possible benefit to earn a quarter of coverage, that went up a bit. And the most important, I guess, the earnings test. If you're under full retirement age, you need to be aware of how much you're making so that you don't have to pay back some of your benefits to Social Security the next year. Now, this amazes me because when Social Security first started, the only recipients were workers, retired workers. That was it. None of these other categories even existed. But as time's gone on, a lot's been added to the program. So workers have to have at least 40 quarters or 10 years, which most of us work like 50 or 60. So that's not usually too hard. Spouses, sometimes you'll have like a lower earning spouse and a higher earning spouse. So the lower earning spouse is eligible for a spouse benefit to increase their benefit. And then there's survivors. If your spouse passes away and their benefit was higher than yours, then you can transfer over to that amount. And also ex-spouses can take advantage of that too. Children, if they're under 18, or if they're adult disabled children that have been disabled since before the age of 22, they can also get, they can take advantage of their parents' benefits at some point. And disabled workers, if a person becomes disabled before their full retirement age, they can apply for disability and get Social Security disability insurance, which will give them the same amount they would have gotten if they had waited till they were full retirement age. How is my benefit calculated? Social Security has a record of your lifetime of earnings. When you reach the age of eligibility, which is 62, they take a look at your entire lifetime of earnings. They adjust for inflation those years from when you started working up till the time you turn 60. And after 60, as you continue working, then those wages are counted as what you actually earned. They're not adjusted for inflation. So they take the top 35 years of earnings, and then they apply their formula to it to come up with what eventually ends up being a full retirement age benefit. They divide the amount of your 35 highest years by 420. That's called your average index monthly earnings. And then that's divided into 3 segments. And you can see the chart with the percentages and the amounts for 2023 and how the formula is applied. And that's how they come up with your full retirement age benefit. The full retirement age has changed over the years. When Social Security first started, it was 65. You can see it didn't stay 65 for very long. It started increasing by 2 months per year. And then changes were made to keep that progression going so that now people who are retiring now are eligible for their full retirement age benefits between 66 and 67. And you can see with the chart there the different years and exactly how many months or exactly what month you're eligible for your full retirement age. And it's possible that that could go up again, depending on any changes that are made to Social Security, but it certainly won't affect anybody who's eligible or close to eligible at this time.
Okay, well, my name is Russ Glore. I'm also known as Rusty. If you read the articles in the Village's Daily Sun, those are my articles. So this particular chart talks about the distribution of when people claim Social Security. This is kind of across the board, everybody who claims. You can see the most popular is age 62. A lot of people say, well, I'm 62, I worked my entire life, so therefore I'm going to take what I'm entitled to. And that's the majority of people do that. The only trouble with that is now somebody who's with a full retirement age of 67 is actually taking only 70% of what they would otherwise be entitled to. The sooner you claim, there's actually an 8-year window to claim Social Security, starting at age 62 and ending at age 70. It doesn't really end at 70. You could go longer than that without claiming, but you don't get any additional money. So the window is 8 years. If you claim at 62, you get 70%. If you claim at age 70, you get 124%. So there's a big difference. The difference between claiming at 62 and claiming at 70 is if you claim at 70, you get 76% more than if you had claimed at age 62. So you can see that. Now you can also see that by far the majority of people claim at or before their full retirement age. This chart is actually a couple of years old. I've noticed personally that the trend seems to be people are starting to wait longer. It has to do, I think, with the whole demographic thing about people are working longer. People are not retiring sooner. Arlene talked about the earnings test. Now, if you claim before your full retirement age, there's a limit to how much you can earn, and people are realizing that. Those who are working longer until they get older will face a penalty if they are also claiming Social Security benefits and they exceed the earnings limit. The point on this is that you have this 8-year window. Most people claim at or before their full retirement age, but there's a significant benefit to waiting beyond that. And this kind of shows the difference. The difference in the bars is the blue bar represents those whose full retirement age is age 66. The orange bar represents those whose full retirement age is age 67. And you can see the growth in your benefit depending upon the age that you claim. If you claim at 62 over here compared to age 70 over here, you can see that your benefit grows really a lot the longer you wait. This is something that it's not the only reason. Breaking even on your money is not the only reason to claim benefits at any one age. There's always a reason. Everything should be looked at considering your whole thing. But when you will break even money-wise, it's at least one of the things that you should look at. I can tell you I've done so many of these analyses and they all come out the same. If you wait until your full retirement age to claim, instead of claiming at age 62, when you're 78 years old, you will have received the same amount of money from Social Security. That's what I call the break-even age. So the numbers are a little bit different depending upon the age that you actually claim. If you claim at 70 instead of 62, you'll break even at 81. And if you claim at 70 instead of your full retirement age, you'll break even at 73. depends on, the numbers vary a little bit. The age, break-even age varies just a little bit, but it's always right in that range. And just to emphasize that, when you break even, money is not the only reason to decide when you're going to claim Social Security. There are a lot of other factors that you should look at. But when you break even is at least one of them. So this chart here, we hear this a lot as advisors, both on the phone and email. People who say, I will never get back all of the money that I've contributed to Social Security. And frankly, that's not true for almost all people. You actually will break even within 5 years. From the money that you put into Social Security, you'll get that back within 5 years. What you see here in the blue is the tax that you have paid, the payroll tax that you've paid. And what you'll see in the orange is the amount of money that most people actually collect. These 4 columns represent 4 different categories of earners. One is somebody who, the one on the left, someone who has earned 50% of the national wage index. The next one is 100%, the next one's 150%, and the next one all the way to the right is someone who has earned the maximum possible benefit. This over here on this side represents the number of months. The numbers on top are the number of months it actually takes to break even. So get back what you have contributed to Social Security. Okay, so the argument that we hear is, I'll never get back. The answer is you certainly will. It's not 100% of the people, because some people frankly start collecting and don't live 5 years after they collect. But on average, you're gonna get it back.
My name is Kenneth Barron. I've been with this great team of Social Security Foundation advisors for just a couple of years now, and so proud to be part of the great team who knows so much about Social Security and able to be out there dispelling, like what Rusty was saying, dispelling a lot of the myths and helping people with their options and giving some sound advice. One of those sound advices, and something we see quite often, is something that is so misunderstood. And it's about, how much can I earn and still collect my Social Security? So here's the bottom line. If you're getting retirement benefits, if you're getting widow's benefits, if you're getting child, spousal, whatever it might be, before you reach full retirement age, based on the chart you saw earlier, based on the year of your birth, you are subject to the annual earnings test set by Social Security each year. And these amounts go up every year, okay? They do change. So let me talk about, folks, before you reach full retirement age and you decide that you want to apply for Social Security early. Okay, what I mean by early, maybe 62, maybe 63 in 2 months, maybe 64 in 1 month, who knows, okay? It's based on your own personal decision. But that personal decision also has to look at several things. First of all, one of the biggies is health insurance. That'll be covered later. One of the biggest ones, of course, is, can I still work? And yes, you can, but there's a limit as to how much you can earn. For 2023, $21,240 is the annual earnings limit. This is not saying you can earn up to that and then start collecting. It means that for the calendar year, you can earn up to the $21,240 1 month, 3 months, 6 months, 12 months. Stay under that amount for the year. You can collect all of your checks. If you expect to go over that amount, you're going to lose $1 of your Social Security check for every $2 over this amount, okay? So 50% of the amount over $21,240 is what basically Social Security is gonna hold back. How does Social Security know this? You are expected to let them know, okay? The agency cannot read minds. So if you're applying for retirement benefits, one of the questions on your retirement application is going to be, do you plan on working? Yes? Okay. How much are you going to earn? Okay. If you're going to be under 21,240, Social Security is going to say, great, we can pay you all the checks you want for the year. If you say, no, I'm going to be a little over 21,240, they say, well, then you may be forfeiting some of your Social Security benefits. Maybe a month's check, maybe 2 months, 3 months, who knows, okay? Based on the month you start, based on how many months Social Security can pay you for the year, there's a lot of variations there. It's different for everyone, okay? So one size does not fit all here about this earnings test. This is a very often misconceived process and trying to understand how the retirement earnings test works. We're proud that we can be out here to help you with this, all right? We know how the earnings test works. Reach out to us if you need to. Obviously, you can reach out to Social Security as well. They always have the final word, okay? We are not, unfortunately, connected to their systems or their personnel. So just remember, prior to full retirement age, there is a retirement test. We have a question. Okay, so the question is the 21,240 based on gross wages or something else? It could be a net, it could be whatever it might be. Well, if you're working for wages, you're getting paid a wage, you're going to get a W-2 form, it's your gross amount. If you're self-employed, then it's going to be your net amount. It could also be, Social Security could also be looking at how much time are you rendering in your business, okay? If you're working for yourself, it's not a corporation and anything as such, that's easy. Your tax return is going to tell Social Security how much you earned. It's a net profit, okay? Do not count in that 21,240. Do not count, oh, I get another pension. Oh, I'm getting investments. I'm drawing off of my IRA. Oh, I'm going to get some mutual funds, or I'm taking something out from my savings. Don't count that. All Social Security is looking at is, you said you're retiring. They're basing this on, okay, you say you're retiring. Are you working? Retirement usually says you're not working, okay? Well, some people, yes, some people no. So anyhow, so I think that answers the question, but there's a lot more that you can get information about as well, okay? I put a plug for Social Security. They have a great website. You can go on there. They have all kinds of publications about working and explaining a few things. If you can't get through to Social Security, you can't, maneuver through their website. Here we are to help you, okay? We usually pride ourselves getting back to people as soon as we can, okay? So this is for folks, again, before full retirement age. The year that you turn full retirement age, the earnings limit changes a bit. Quite a bit, actually. If you take a look this year, for instance, you can earn up to $56,520 up until the month before you reach full retirement age. So let's say your full retirement age is 66 and 6 months. And that month is going to be the month of July of 2023. Well, starting with the month of your full retirement age, Social Security doesn't care about the earnings limit anymore. You can earn anything you want, okay? Earn anything you want, starting with that month. Collect all the checks if you want. The bottom line. But up until the month before, there is that limit. And again, Social Security looks at a calendar year. So, same example, January through June. You're still working full time, you earn less than $56,520. You could apply to get your checks as early as January. And Social Security will pay your checks all 12 months. You'll still get your $56,000 in if you earn up to that or less, and whatever else you're earning for the rest of the year. You just need to make sure that Social Security knows the breakdown of those months and when you earned and what you did earn from January through June, okay? And that's why they have that 1 for 3 earnings. If you do expect to go over the 56 plus, then you can still apply for Social Security, but you're gonna lose $1 for every 3 that you go over 56, okay? And that's just for January through June again. Now, if you're gonna earn 100,000 between January and June, first of all, I want that job. But that means that you probably should be holding off applying, okay? Depending on several factors. Number one, obviously, how much you're gonna earn those first 6 months. Number two, how much over, and what is the monthly earnings test as well. The 4710 is what Social Security is saying, well, you could earn 100,000, but maybe you'll make that in 1 month. You do a consulting job that pays you 100,000 in 1 month, okay? Well, maybe those other months, we can still pay you Social Security checks as long as you don't go over 4710 in those months. Again, I'm only talking about the months before you reach full retirement age, okay? It can get complicated, as you can see. Sometimes it does. Sometimes there's variations. Sometimes there's changes in your life. I remember people telling me, look, I'm going to earn this. This is the way it's going to work. Halfway through the year, it didn't work that way. Okay? Pick up the phone, call SSA, and say, look, this is what I estimated. This is what I thought was going to work. It didn't work out that way. They will go into your record and make those changes, either release checks out to you or hold back some checks. Better than being overpaid at the end of the year, okay? And then SSA says, why didn't you let us know? Now you're overpaid, and potentially they can charge you a penalty, sometimes an extra month's benefit. Okay, all right. Let's see what else we have here. All right. Are Social Security benefits taxable? Yes, they are. All right. I remember when this came out, man, I mean, it seemed like the world was coming to an end. We've already paid taxes. Now we're paying more taxes, and you know how that goes. Okay, well, unfortunately, it's what we have to work with. This is what we are dealing with. The modified income levels, as you can see, if you're filing a single return and your income is between 25 to 34,000, Social Security up to 50% can become taxable income. Married filing jointly, 32 to 44,000 as a couple. Up 50 to 85% of your Social Security can become taxable. We're not going to claim to be tax professionals or tax experts. I always recommend, usually if it's a simple question, we say, yes, it probably will be taxable income. Okay, what you're telling us, what your income is going to be for the year. If you have more specific questions about what your taxation level is going to be and what category you fall into, please seek a tax advisor, a CPA, someone you trust, someone that already works for you doing your taxes each year. Call them, let them crunch those numbers so you know. The other thing is that you can have a certain percentage of taxes taken out of your Social Security check if you know it's going to be taxable, okay? You file, it's an IRS form. This is IRS rules, folks, not Social Security, okay? Remember that. You can file an IRS form W4V. You can download one off of IRS and Social Security's website as well. And you'll see the selections, the percentages that you can have withheld. Okay, moving on. Maybe. Yes. I wanted to get to this and explain a few things about Social Security disability insurance. SSDI, Social Security Disability Insurance. The insurance part of any benefit Social Security pays out should be that bell, that light bulb that goes off, okay? Insurance, something I paid. retirement insurance, spousal insurance, disability insurance, child insurance. Parents paid for that. The other program that Social Security administers is called SSI, Supplemental Security Income. Don't mix the two together. SSDI insurance is paid out from trust funds. Money you paid in, money that's gone into these trust funds, just like the survivor, the retirement, and everything else. That's where these payments are coming from. SSI, Supplemental Security Income, is funded from other federal general revenues, not from Social Security taxes, okay? It is people may not like this, but it's a welfare benefit. It is a federal welfare benefit. And like this program, the SSDI, the medical part of it must be met no matter what. Then Social Security determines what you're going to receive from what program. First program they're going to pay you from and they're going to look at is the SSDI program, the Social Security Disability Insurance. There are certain things that you must meet in order to qualify. If you are still working, if you are still earning over a certain monthly amount, not sure it's up here, it's not. Anyhow, if it's over a certain monthly amount, it is considered to be substantial gainful activity. In other words, you're earning too much to qualify for disability. And even though you may have a disability, and I've seen this many times with disability applications, if you are still working, even though that you have cancer, even though that you have ALS or Parkinson's or whatever it might be, okay, and you're being paid over a certain monthly amount, you do not qualify for Social Security disability insurance benefits. Okay? Social Security you'll file your application, they'll turn it down without a medical decision. Okay? Because it's a waste of their time. First of all, believe it or not, because you don't meet the financial guidelines. Now, somebody has a disability, they stop working, file right away. There's no thinking about this. You go online, you can file your application electronically with Social Security. Easy process, just a long one, okay? It's a long one because you're expected to provide medical doctors, physicians, hospitals, clinics, as much information as you can provide to Social Security to make that medical determination. It is to your advantage. Okay, all right. So you hear all these stories that you should file for disability as soon as you can because it can take years. I've seen some cases to take years. I've also seen some cases within a week. I had their decision on my desk approved. Okay, why? Because of compassionate allowances, which was about time that Social Security brought this out. What is a compassionate allowance? Compassionate allowances is illness, a disease, something that is pretty much life-threatening. It can be a terminal cancer. You have 6 months to live. Maybe you have 3. It can be ALS. It can be Parkinson's. It can be all kinds of things. There's well over 200 of these now. Social Security has them listed on their website. If you do qualify under compassionate allowance, your application with Social Security is going to like that. Why do you hear about those months and months and years? Because how many people are happy that their claim took that long to be processed, first of all, okay? Versus the ones who got approved within a week or a month or 2. Those people are not out on the street saying, hey, I just got approved for Social Security disability within a month. You're not going to hear them boasting about that. You're going to hear those who are not pleased, though, okay? So there are 2 sides to the story. I always tell people, please, please apply as soon as you stop working. Yes. This is a great question, is that what basically qualifies a person's income under Social Security? for disability. It's very different from the retirement process, where you heard, I think, talking about the 35 years and so forth. The process is different for someone who is not yet 21 years old. It is different for someone who is 21 to 31 years old. There are a certain amount of credits that you must have earned prior to becoming disabled, okay? There are certain disabilities that are catastrophic illnesses or injuries, for instance. I was in a car crash, boom, that day I became disabled. I developed COPD over the course of years. Well, when did it really become disabling? All right. You see the process that the medical agency that works for Social Security has to look at many of these guidelines. And they also have to look at what age you were and how much you had paid into the system by then. Okay, so it's different. For people over age 31, it's easier because we always talk about the 20-40 rule. In other words, over the last 10 years, did you pay into Social Security at least half of that time? There are 40 credits in 10 years that you can earn. You must have paid in at least 20 credits over that lifetime, over that 10-year period, that is, okay? So 20-40, at least 20 credits out of the 40 over the last 10 years prior to becoming disabled, you're considered to be insured. Okay? This is for folks, again, over age 31. And again, there's a lot of information about this online. We can provide that to you as well. We can do a little research for you, as long as you can give us a little more specifics about, not very personal stuff, but just tell us, well, what's your age? When did you become disabled? What's your disability? We can provide you some advice, okay? People who become disabled and they have families can also receive benefits for their families, whether a spouse, minor children, and so forth. And that's why we have that recipient can be eligible for spousal benefits at as early as age 62. If you have a spouse was a stay-at-home mom, and then they are 62, and then the spouse all of a sudden becomes disabled, there's possibility of getting spousal benefits under that person's record. Okay, so with that said, I think I have reached the end of the road with my presentation, and we have Miss Sharon next. All right. We have another expert on board. Thank you, folks.
Okay, I'm going to talk about spouses, ex-spouses, and survivor benefits. These two benefits, the spousal and the survivor, are actually our biggest bulk of questions that we get asked, because there are a lot of decisions to take into consideration when dealing with these two benefits. Now, the spousal benefit is when you have a higher earning spouse and a lower earning spouse, and the higher earning spouse's full retirement age benefit, 50% of their full retirement age benefit amount is higher than 100% of the lower earning spouse's full retirement age amount. Now, they always look at the full retirement age benefit amount, whether you take your benefits at 62, in the case of the spouse, which, like any other benefit, it's going to reduce your benefit. If you wait to your full retirement age when you're eligible for a spousal benefit, you will receive the full spousal benefit, which will bring your own retirement benefit up to equal 50% of the higher earning spouse's benefit, regardless of when the higher earning spouse takes their benefit. If they take their benefits at 62 and you wait to your full retirement age, you're still going to get a benefit equal to 50% of their full retirement age amount, even though they took a 30 to 35% reduction on their own benefit. And then once again, if that higher earning spouse delays to 70, your spousal benefit is still going to be based on 50% of their full retirement age amount. and they have to be taking that benefit. And another thing that affects spousal benefits when making your decision, if you decide to apply for any benefits and that higher earning spouse is already taking their benefits and you're eligible for a spousal benefit, you're going to be automatically deemed as filing for both your own benefit and that spousal benefit. So if you're only 62 when you apply and the higher earning spouse is taking their benefits, you will take a permanent reduction to both those benefits because your benefit is actually a combination of the two. It's your own retirement benefit plus your spousal benefit put on top. Now, even for spouses, say you've never worked your entire life, you stayed home, you took care of the house, you took care of the kids, when your husband or wife or your spouse, whichever the case may be, applies for their benefits, once you reach age 62, you become eligible for a spousal benefit, even though you have no benefit of your own. And then we go into the survivor benefit. And sometimes people get these confused on the amounts. With the survivor benefit, the surviving spouse gets to keep the highest of the two benefits available. And once again, you're going to be dealing with your ages affecting those benefits. You can take them as early as 60 or age 50 if you're disabled, but at that time you would only receive 71.5% of the deceased spouse's benefit. Your own smaller benefit would end. It would be a permanent reduction. And then there's just so many things that affect them. For someone on a spousal benefit, when they're and the other spouse passes away, Social Security, if you've reached your full retirement age, they're going to automatically switch you over to your survivor benefit. If you're under your full retirement age, but you're receiving a spousal benefit, your spousal benefit's going to stop, but they're not going to automatically transfer. You're going to have to actually apply if you want a reduced spousal benefit. If you're on a spousal benefit and don't have your own retirement benefit, they are going to automatically transfer you to your survivor benefit regardless of your age, and you will take a permanent reduction. And then there's other benefits for dependent minor children or disabled adults before the age of 22. We have found this has become quite common, grandparents adopting, second marriages and having children, that there's children available for benefits. So sometimes one of the parents will start their Social Security benefits to get these benefits for the children or the adult disabled children. And in this case, you have what's known as the Family Max comes into play. The Family Max for someone on retirement benefits can actually be as high as 188%. Of course, the person receiving the actual retirement benefit, there is 100% of that Family Max. If there's just a spouse, well, then you know the spouse automatically can get up to 50%. But should a child or an adult disabled child come in, well, that's where the Family Max is going to step in. Ex-spouses, for both spousal and survivor benefits, you have to be married at least 10 years to be eligible. Now, if there is an ex-spouse eligible for benefits and there's also a current spouse, it doesn't matter. Both those spouses are eligible for 100% of that survivor benefit, or say they're both eligible for a spousal benefit, they're both eligible for a full spousal benefit. One does not affect the other's benefits. If the ex-spouse remarries and is receiving a spousal benefit, that spousal benefit will end. If the ex-spouse remarries after their 60th birthday, and it has to be after the 60th birthday, and they're receiving a survivor benefit, they get to keep that survivor benefit if it is the highest benefit available to them. Same thing with a wife, should she remarry, as long as you or husband or whichever spouse, as long as you wait until after your 60th birthday, you can keep a survivor benefit, but you will lose a spousal benefit. And do not get married before your 60th birthday, or you lose that as long as you're in a current marriage. And a lot of things that ex-spouses aren't aware of, and spouses need to be aware of this. There is also a benefit known as the child and care benefit. This comes into play when there's a member of the family's on benefits and there's children or adult disabled children come into play. One of the family members, or they could be a single family, becomes eligible for what's known as a child and care credit. And that comes into play when you have children under 16 years old or an adult disabled child before the age of 22. This is the only time an ex-spouse's benefits can affect the family max, because an ex-spouse with a dependent child or adult disabled child is eligible for the child in care credit, and the length of marriage does not matter. And her benefits, and of course the other children's benefits, will affect the family maximum. The difference between a current spouse and an ex-spouse being eligible for a child and care benefit is a current spouse or a spouse at time of death can actually remain on that child and care benefit as long as they have an eligible child or adult child up to their full retirement age. An ex-spouse loses eligibility for the child and care credit at age 62 when they would become eligible for a spousal benefit or their retirement benefit. And then, of course, as with survivors, there is a one-time lump sum death benefit, which is only $255. It was set many years ago, and apparently they just left it on the books because we know you can't bury anyone for that. And that's available to a current spouse or children if there is no spouse, if they are dependent on the number holder that passed away record. And what happens if both spouses have Social Security retirement benefits? Well, if there's just the two of you and no children or parents that are eligible, the family max does not affect you. You can both have maximum benefits. You're not limited by the family max. You each have your own separate benefits. You're eligible for those full amounts. Okay? And that would bring Ken back. Well, you will. Yeah.
Thank you, Sharon. So I'm sitting here listening so far to Russ and Sharon and Arlene. We've yet to bring Eileen up. I think I made this remark within the last couple of years I've been working for this agency. I have to put this in there. look at the knowledge this team has about Social Security and the programs. I wish we would have had this team, and we still could bring this team on to train Social Security employees today. And if there's anyone out there listening from Social Security, if it's a dig, good. You should take note that this is one heck of a great team who knows their Social Security rules inside and out compared to some Social Security employees. Now I know that for a fact. Anyhow, so let's move on. Okay. This is a biggie. This is a biggie because of the Bipartisan Budget Act of 2015. One group of professionals out in the field, financial advisors, financial folks who would advise folks, knew about some of these rules. File and suspend, restricted applications. What does that mean? That means that you had the opportunity of maybe not filing for benefits under your own record, which might be the higher one if you're a couple, and just applying for spousal benefits instead, just getting a small check for a while, and then waiting until your full retirement age, or maybe age 70 to get some extra credits, and then switch over to that. Well, guess what? Congress got wind of this little ditty of benefits that people were taking advantage of and decided to change the rules, okay? It was phased in a bit. So this Bipartisan Budget Act of 2015 changed restricted applications for spouse benefits. What did it do? Well, this is it. The strategy is no longer available for anyone who was born January 2nd, 1954 and younger. So you cannot take advantage of that any longer. So the last group, as it says up here, anyone that has turned 66 on January 1st, 2020, that's it. You can no longer take advantage of these, of some of these money-making, retirement programs that one used to be able to take care of, take advantage of, I'm sorry. And of course, we have that up there is that if there's still people out there who have not filed for benefits and they were born before January 1954, they should probably hop on that bandwagon and take advantage of this and file a restricted application. Ex-spouses can certainly do the same thing as long as the ex-spouse they're filing under is of retirement age as well, okay? They don't need, so if you have a husband who's, let's say, 65 years old, and you have the ex-wife who turned 62, the ex-husband hasn't filed for his benefits yet. Doesn't matter. The ex-wife could apply for spousal benefits under the ex-husband's record. He does not have to have filed and receiving checks, okay? That ex-wife could take advantage, and it works the other way around. I've seen that, where the husband has filed under the ex-wife's record. And of course, look at this. So divorced spouses are the only ones that can actually file for benefits under each other's records. Interesting, isn't it? Yeah, okay. Anyhow. Cost of living adjustments. I mean, cost of living, what more can we say? It's based on consumer price indexing, okay, the CPI for wage earners and clerical workers. This is something you hear about every single year. Everybody's waiting till October-ish, okay, where Social Security finally comes out with, hey, the CPI came out to being this is what everybody's cost of living increase is going to be on their benefits, on their checks, for federal workers, for whoever it might be. There obviously changes a lot and has affected cost of living increases for folks on Social Security for years. It's ranged as far as I think we heard a while ago, up to 14% 1 year, I think it was. Yeah. And I mean, it's been down to zero for a few years. I remember those years. Now, it can never, if the CPI is lower than zero, people will not undergo a decrease in their Social Security benefits. It cannot go any lower than zero. Quite frankly, why would you want to go below zero? But anyhow, that's the way it goes. Social Security COLA history, as you can see, there's been huge variations. And there it is in 2010, 2011, 2016. Thank goodness I was no longer working for Social Security then. 2010, 2011, I was there. I was taking those calls. Why didn't we get a cost of living increase this year? CPI says this is the way it is, folks. You know, there was no increase. Yet, look at 2023 right now, the projection. 2022 was a pretty good year. Got a pretty sizable cost of living increase this past year. And again, it was all because of that consumer price indexing. I mean, take a look at everything, how high everything was. One of the biggest things that affects CPI a lot of times is the oil industry. Obviously, you know, food, everything else involved that we've been hearing. Just recently, I heard on TV, food prices from last year are up to somewhere on an average almost 12% more than last year, this time last year. It's pretty crazy, but that's the way that life is. You know, that's what we have to deal with. On that note, I am going to turn this microphone over back to Russ. All right, Russ. Here's another great expert, folks. Thank you.
Thank you, Ken. So I just want to go back to something that Ken said, because he has the credentials to be able to say it. Ken, you had what, 34 years with the Social Security Administration, so we're delighted to have him and his expertise on board. But he mentioned something about Social Security employees today who you might speak with on the phone. A pretty sizable percent of the contacts that we get are from people who have tried to contact Social Security, either been unsuccessful because of phone difficulties not being answered, or being cut off after they do finally get someone to speak to, or they get incorrect or conflicting or not understandable information. So we do get a lot of that. So Ken has the credentials for anybody out there who might take exception to him saying that. He has the credentials to stand behind that. The other thing I wanted to mention was the COLA increase of 8.7%, which there was much media hoopla about how wonderful it was that we all got an 8.7% increase in our Social Security. The thing to keep in mind with that is that's all after the fact, because that was determined based on 2022 numbers. So we can't catch up on that. You kind of lose buying power. You can probably take to the bank that's not going to be anywhere near that next year. It's probably going to be much like more closer to the average, or closer to the average of 2.1 or 2.2 or 2.3% on that chart that's up there. And the reason for that is because the CPI for the third quarter of next year, which is what it's going to be determined on, is probably not going to be that far away from what it was for 2 years compared to each other. So you can say you heard it here. It's not going to be 8.7% next year. It's probably going to be more like 2 or 3 or 4. So this maximum taxable earnings thing, I remember when I was just a youngster, which seems so far away now, being thrilled that at some point in the year I would get this huge raise because they would stop taking Social Security out of my paycheck, and I really felt good. The maximum taxable earnings back then were a lot lower because I was making a lot less money back then also. Right? The fact is, when you hear people talking about, well, you know what, we got to tax the rich and we got to take off that cap, the fact is it actually goes up every year. It automatically goes up. So it's up now to 160,000 and change. And it's going to go up again next year. So the amount of money that people are paying Social Security tax goes up every year, and it's going to continue to grow up. It's 160,200 now, which is, as you can see, is 8.25% up from the previous year. The national average wage index is what determines that. I don't even want to try and take you through how they figure that formula out, because, as it says here on the chart, it'll make your eyes glaze over. It makes mine glaze over. And I avoid discussing it whenever I can. The maximum Social Security payroll tax for 2023, $9,932. There are going to be very, very few people. In order for you to get that, you'd have to earn. Well, no, never mind. I was going to say something else, but you have to have earned that 160,000. These days, I don't earn that anymore. This kind of emphasizes something I hinted about a moment ago. That is that Social Security is actually a progressive system. It kind of favors lower income people to give them a higher benefit or a higher percentage of benefit than it does for higher income people. This number here, it's hard to see on this chart. This is the amount of benefits that you will receive, and this is the amount, your average indexed monthly earnings, as we discussed earlier in the presentation. The amount of benefit that you get is likely going, on the lower side, is going to be likely about 40% of what your average indexed monthly earnings were. That's for people in the lower income bracket. Conversely, people in the higher income bracket are going to get a much smaller percent. I've looked at these. Someone over here in the low income bracket is going to get about 40% of their pre-retirement income. And somebody over here is going to get about 20%. So Social Security is a program that favors lower income workers. It's weighted to provide a better benefit for people with a lower income. And Sharon and her favorite subject, the windfall elimination provision and the government pension offset.
This affects people that work for government agencies, teachers, police fighters, firemen that work in positions that don't pay into Social Security. They get a pension in lieu of it. And back in, like, I think once again, 1983, it was considered double dipping. So they created WEP, which takes someone's Social Security benefit and it reduces it based on, they have special years, substantial earnings, they call them. And if you have at least 30 years of substantial earnings that you paid Social Security taxes outside of the position, then you're no longer subject to WEP. If you always worked in that position, never paid into Social Security, you're going to take the full maximum reduction. And when you get into this topic, there's a lot of calculations that can be involved, but it's something people need to be aware of if they do take a position where they find out they're not paying into Social Security. If you don't have that full 30 years of substantial earnings in addition to it, this is definitely going to affect your Social Security benefit. And when your own benefit is reduced by WEP, it's also going to reduce your dependents benefits. If you have a spouse or children, their benefits will be based on your WEP reduced benefit amount, except in the case of survivor benefits. Would the person subject to WEP pass away, the dependents will receive full benefits. The WEP reduction does not apply, even if they're eligible for the deceased pension, they get to have both. And these were what I'm talking about, substantial years of earnings where you can work yourself out actually with 30 years. For 2023, someone that doesn't have those substantial earnings or less than 20 years, there is a maximum deduction. That maximum reduction is $557 for this year. It does increase every year. WEP can never reduce your Social Security benefit by more than 50% of your pension. And as I mentioned, this only affects people that don't pay into Social Security. And this is just an example of how the bend points are affected. The only bend point it affects when they're determining that WEP reduced benefit is the top bend point. So like you normally get 90%. If you're affected by a maximum WEP, you're only going to get 40%. The other two bend points aren't affected. So there's a lot of confusion on people think they're getting a bigger reduction than they are. It only affects the first bend point. Now, the government pension offset, this affects spousal and survivor benefits of people that have a pension from a position where they didn't pay into Social Security. And this is the one that can really be severe. It actually reduces those spousal or survivor benefits you may be eligible for by 2/3 of your pension. It can actually zero out any and all benefits you may otherwise be eligible for, whereas the WEP can't. And as this is based strictly on anyone affected by this and their substantial earnings and stuff, I strongly recommend if you are affected by WEP or GPO and getting ready to retire, that you call and speak with one of the advisors. And now I'm going to turn it over to Eileen Cook. We call her our Medicare guru.
Fair warning, I have an accent and I talk fast. So if you can't understand something, just let me know. All right? That's fair warning. So Medicare, you do not need to take Social Security when you enroll in Medicare. Medicare is when you're 65. And there's parts of Medicare. It's Part A, which is inpatient. Part B is outpatient. Part D is the drugs, which makes sense for once in their lives they did something correct. And Part C is Medicare Advantage, and we'll talk about those. And as you can see, I'm not going to read you the whole slide. Part A is free for those eligible for Social Security. And Part B is the standard premium is $164.90. And Part D, it depends on your plan. Some people pay, some people don't. And Part C may or may not have additional coverage over the cost of Part B. Okay, how Medicare is funded. This is really interesting. We get a lot of questions on this because all I hear is, I paid my taxes, why do I have to pay for Part B? Well, as you can see from this, Part A is mostly from your payroll taxes. That's why you get it free. You've paid into it and that's it. Part B, now they're set at 73% comes from the general revenue. By law, 25% is what is Part B premium. So that is law. So there's no way of getting around that unless Congress changes it. Part D is from the general revenue, and then you have premiums is 15%, and then the transfer of the state is for those individuals that have both Medicare and Medicaid dual eligibles. Now, you notice that Part C is not up there. We'll talk about that. Basically, Part C is paid, Medicare pays private insurance companies to manage your Medicare Part A, B, and most of the time is Part D as well. So that's where that comes. They don't have a separate trust fund because there is a trust fund for Part A, which you may have heard is HI Trust Fund, which is in deep trouble, but they've never gone bankrupt. Right now, if they don't do anything, by 2028, they're only going to be able to pay 90% to the hospitals and nursing homes. So that's where that comes from. Part B and Part D come out of the SMI Trust Fund, Supplemental Medical Insurance Trust Fund. Now, Part C, like I said, is paid by Medicare. Medicare pays Part C, based on each individual enrollee, and the Medicare Advantage plans do a bid every year. And they have to hit benchmarks and everything else, and depending on a lot of other factors. But Medicare pays for each individual as Medicare Advantage. They'll pay that plan a certain dollar amount to manage that. And that's how that works. Because I get asked that all the time too. Now, Medicare, it's wonderful. It's wonderful for what it purpose was, that to give medical coverage for people 65 and older, especially back in the 60s. So, but Medicare doesn't cover prescription drugs. That's Part D. Well, they do, but it's in the hospital stay and everything else. It's very complicated. Eyeglasses, exams to get glasses, hearing aids, exams. You know, this is, and long-term care is something that it's custodial care. It's not when you go, you break a hip, you go into a SNF, then Medicare will pay for your rehab. But if you pass a certain amount of days, then you go into custodial care, and Medicare will no longer pay for that room and board. So that's, and then we have the routine foot care. Now they do for diabetics, so that's a different story as well. So, but as you can see, Medicare only pays 80% of covered service, and then the person who doesn't have a supplemental plan pays the 20% out of pocket. And there is no out-of-pocket maximum with Medicare. I mean, you hear, oh, I hit my out-of-pocket maximum, you know, with your Medicare Advantage plan, or if you have group health plan, oh, I hit my out-of-pocket maximum, now I get everything free. For Medicare, there is no out-of-pocket maximum on original Medicare. So most people, what's called a Medigap plan was a supplemental plan, which is private insurances, and there's 12 policies. Now they're regulated by federal and state law, and they have to be marked as supplemental, Medicare supplemental plan. And that's important because lately a lot of people have gone before Congress and saying that Medicare Advantage plans named that way is very, I don't want to use the term that they use, but it's deceptive because they think where Medicare supplement plan actually tells you you have Medicare A and B, their supplemental thing. So that's, if you hear that getting floated around, that's what it's about. So, and Medicare Advantage, like I said, is the combination. Think of it, Part C, as a combo plan. It does your Medicare A, your Medicare B, and most of the time it does your D too. There are very few plans. I think only 88 plans that Medicare Advantage plans do not include a Part D plan coverage in there. So in 2022, 48% of the Medicare eligible people were enrolled in a Medicare Advantage plan. And out of that 48%, only 69% did not pay an additional premium on top of their Part B premium. So the other half paid additional premiums, but other than that, 69% of that did not, which I think is great. So now, do I need to take Medicare? That's another question we get all the time. You must have Part A to collect Social Security. I know a lot of people don't like that idea, and there is a thing going about where they want to uncouple that, where, you know, you can take your Social Security, and especially if you're still working and you have a group health plan and you have a health savings account, that once you take your Social Security, you're in part of Medicare, and you can't have a health savings account with Medicare. It has to be a high deductible plan, which Medicare is not. So that's one thing that's been kicked around. And Part B isn't mandatory because there's a premium. And also Part D is not mandatory because it's a premium. However, if you do not take it, let's say, oh, I don't go to the doctor, I don't do this, I don't do that. 2 or 3 years down the road, you have a major health crisis. Now you say, oh my God, I got to pick up Medicare Part B. Well, you're going to pay a penalty for doing that, for holding off. Part B penalties is 12 months. Anything is 10% for every solid 12 months that you went without coverage for Part B. Part D, the drug coverage, is 63 days. And after that, it's 1% for each month that you went without. So actually, technically, not only are you paying 10% penalty for Part B for, let's say, 2 years, you're going to be end up paying a 24% penalty on your Part D because you went 2 years, which is 24 months, and they charge 1% for each month. So that's a lot. And we always tell, think very carefully about that. You can't, I just advise them and I give them that scenario. You may not take drugs now, but you don't know down the road what's going to happen. It's almost like having car insurance, a house insurance. You may not use it, but when you need it, it's there. And that's the most important part. I'm sorry, I got off on my soapbox. I always get on this soapbox. Sorry, guys. Like I say, you can defer enrolling in Medicare if you have credible health care coverage from your employer. Now, credible health care coverage or group health plan has to be more than 20 people enrolled on that plan. It also has to be equal to Medicare. Now, if you have less than 20, sign up for Medicare. That group health plan you have could be your supplement plan. So that's what you can do. But if you have credible coverage, your group health plan is more than 20 employees on that plan, you don't have to sign up for Medicare at 65. Okay, but once you do lose that coverage, sign up. Do not go more than 63 days. That's so. And now we're going to get to the fun part also. Medicare income-related monthly adjustment amount, IRMAA. IRMAA is the additional amount of the Medicare Part B and Part D premiums, as you can see, based on your modified adjusted gross income from 2 years ago. Now, you can see individual, filing jointly, and file married and separate. So if your modified adjusted income for 2021 fell within, let's say, if you're a single, 183, you're going to pay for Part B $527.50 plus $70 plus if your plan, Part D plan, has a premium. Now, there are ways of not paying IRMAA, and that is what's called a life-changing event. A life-changing event is marriage, divorce, annulment, loss of income property, producing property, retirement or a work reduction, property, and then pension, the loss of a pension, or employment settlement. Usually with employment settlement is when they go out of business and you're giving, severance or whatever is available. So when that happens, you can fill out a form, which is SSA 44. And we have a lot of people who either sold their stocks. Actually, I had one that was very interesting recently, actually last year when she first got the notice, was she sold rental property. She lived in California, and it was during the pandemic. And she wasn't collecting, she couldn't evict them because of the eviction mandatory moratorium on them. She wasn't collecting the rents. They were vandalizing, the residents of the apartment building were vandalizing the apartment building. And she says, I had to sell it. I couldn't keep this. And she goes to IRMAA. And I said, well, you know what? That is income loss due to fraud because you weren't collecting rents and you couldn't evict them. So I said, you have all of that information. You have police reports, everything. File your SS 440 and 44 with all the documentation saying you had to file because you lost income and this is the reason. So that's one thing. Usually income has come through fire and natural disasters and everything else, but if you cannot afford it, for whatever reason, there is another form that you can fill out, which is 561, which is reconsideration based on a financial hardship. So you can fill out that form as well. So, and that usually, and IRMA usually only lasts a year. If, let's say, you sold some property, you sold your house up in North or another vacation home or whatever, that only lasts a year, and then it'll get recalculated the following year. So I think that's it for me. I thank you very much.
Well, that pretty much completes the prepared part of our material for today. I'm Jerry Hafer. I work with the AMAC Foundation. I've been with the foundation since the beginning, 2013. And I'm going to take this opportunity to talk to you about Social Security in the future and its solvency issue. Have any of you ever heard that proposed anywhere in the news, like Social Security insolvency? Has anybody ever heard the rumor that Social Security is going broke? Yep, prevalent rumor. You guys can't answer that question because they hear it every day. But the reality is Social Security is not going broke. You probably also heard the rumor that the politicians stole all the money from Social Security. That's a pretty popular rumor. We hear that one every week too. And I will say that's not true, just as the Social Security going broke is not true. But having said all that, I do have to tell you that Social Security does have a problem, and that's what I'd like to talk to you about. So what is the problem? The problem is that Social Security has been operating since 2021 in a deficit mode, meaning that it's paying out more benefits than it's taking in terms of income. And so it's been relying on its accumulated reserves, and those reserves had reached about $3 trillion in the end of 2020. So starting in 2021, the program is drawing on those cash reserves to continue paying benefits in full. The problem is that can't continue, and over time, the reserves are going to be completely depleted. And at that point in time, there'll be a substantial reduction in Social Security benefits. I'll talk a little bit more about that in a second. I'm giving you a condensed version of this whole discussion on solvency. And if any of you have an opportunity to come out to our Aging at Home Expo on Friday, I will be doing a detailed version of this. I just don't want to get into too many numbers now in the interest of time. But I'm going to talk about what is the problem, how do we get there, and what can we do about it. Let me just read this comment from the Congressional Budget Office, long-term budget outlook from last year. CBO projects that the Old Age Survivors and Disability Insurance, OASDI, trust funds, that's the reserves that Social Security is using right now to pay benefits, would be exhausted in calendar year 2033. That's not that far away, 2033. And what that being exhausted means, the second part of that quote, the total reduction in annual benefits necessary for the trust funds outlays to match their revenues in each year after the trust funds are depleted would be about 25%. In simple terms, that says if nothing is done, if Congress kicks this can down the road further, as they have been for decades now, then come 2023, everyone's Social Security benefits will be cut 25%. This is the CBO estimates. So if you get a Social Security check of $2,000 a month, it automatically gets cut to $1,500. That's a severe hardship for people that are existing on Social Security. So that's the reality of the problem. In terms of how we got there, I'll talk a little bit about how we got there. Well, as a society, we're living longer. When Social Security was put into effect in 1940, when benefits first started being paid, a person reaching age 65, well, let me say it differently. Today, the life expectancy for somebody reaching age 65 is 52% longer than it was in 1940. And so that translates to many more years that Social Security has to pay benefits. That's a big part of the problem. Another part, of course, is that less workers are paying into Social Security these days. Back in the, even in the 1950s, the ratio was about 16-1, where there were 16 people working to pay Social Security tax for every beneficiary. This year, it's 2.7-1, projected to drop to 2-1 by the end of this decade. So there are less people paying tax into Social Security, which is why Social Security is now in a deficit mode. Another part of the problem is historic low interest rates. I mentioned the $3 trillion trust fund balance. The interest rates are coming back now, but for most of the second decade of this century, they were very low, historically low. So that income portion of Social Security was kind of suppressed. So all of that is what's creating this problem. And the bottom line is that the trust fund reserves are now consuming themselves. And that's a problem that will continue until 2033, as the CBO estimates. So for a pictorial representation of the Social Security trust fund balance, this is what it will look like. You see a little bit of an increase in 2021 or 2020, and then in 2021, if you look at the chart closely, you'll begin to see the drop, and then just gets more pronounced all the way to 2033. And then in 2034, it hits zero. And that's when the benefits would need to be cut, because by law, Social Security would be required to operate on a cash basis. It can only pay out what it takes in. So that in a nutshell. And I heard one time that anything that can be put in a nutshell belongs in a nutshell, but that's neither here nor there. But that's the solvency problem. So at this point, in terms of Social Security's future, we have two options between now and 2033. Option number one is do nothing. And that seems to be the most politically expedient option. And so if the option of doing nothing is exercised, basically you're endorsing a cut in benefits. The other option is to fix it. And we at AMAC have been working hard on crafting a solution to fix this problem. Getting the attention of legislators is, I'll be polite and just say it's difficult, but time is running out, frankly. And Social Security needs to be brought in to match 21st century economics. Social Security has been in effect for 87 years, roughly. And basically, no structural changes have been implemented in those 87 years. That quote at the bottom of that chart is a quote from Mark Warshawski, who is, I read a lot of his material. He is very well versed in Social Security history and the internals of Social Security. And it's a telling comment that basically nothing's been done. And so Social Security is not reflecting 21st century economics. And that's what we're trying to deal with at AMAC. And here are some of the things that we're proposing. We have a plan called the Social Security Guarantee that we are pushing in Congress. We have people up in Washington all the time beating the doors of congressmen trying to get their attention. And we have a number of things that we're proposing. This is the current version. We just updated it this year. And we're advocating things like advancing the full retirement age from at 67 now to age 70, again, in recognition of people with longer life expectancies and working later in life and that kind of thing. And I won't go into these in any real detail, but we're talking about making some modest adjustments to the calculations, basically to extend the life of Social Security. Our basic premise is that the promise of Social Security must be preserved. And we think that there are ways to do it without, and I say this strongly, without increasing taxes. We don't think tax increases are necessary to fix this problem. We think it can be done with internal adjustments and the things that we're recommending. And there's something in this plan basically for everybody. We know that when we go public with this, we're going to get a lot of feedback. Not blowback, I think is probably a better term. But there's something in this plan for everybody. For example, we've added some things like we recommend eliminating, what I think it was Ken talked about, federal income tax on Social Security benefits. We're recommending that be eliminated, either eliminated or the thresholds adjusted, because they haven't been adjusted for decades. So these are the detailed recommendations that we're putting forth in our Social Security guarantee. And we're cautiously optimistic that we'll get congressional attention. We are working with a number of congressional offices, actually, who are trying to develop their own plans, and we're saying, we have a plan, just listen to us. So as I said, I am cautiously optimistic that we will be able to get the attention we need and we can get this fixed. The longer it takes to fix it, to craft a solution, to agree on a solution, the harder it's going to be to fix. And so you all can help us by contacting your congressman and saying, you got to do something. And by the way, AMAC has a plan. And we're getting very well known in Washington these days. A lot of people talk about it. A lot of people recommend things like, it's easy to fix, increase the taxes. That's why we think a tax increase is not the way to do it. The working population is already burdened with taxes, and we think there's a better way. So you can help us. Just contact your congressperson and tell them to get on the ball and tell them to call AMAC, and we have a solution. And I'll get off my soapbox now. So wrapping up, of course, thank you for being here. Those of you that will watch the video, thank you for paying attention to our presentation. And, as these folks have said earlier, we're here to help. We're very proud of the Social Security Advisory Service that we have. And anytime you need us, just get in contact with us. Regarding the foundation itself, pay attention to our website, amacfoundation.org/events. That's where we advertise upcoming events. For example, the Aging at Home Expo that I mentioned on Friday. I would encourage you to attend that. That's going to be an interesting expo. But it's an action-packed website. There's a lot of information on it. If you want to know more about the advisory service, there's a separate page for that, amacfoundation.org/services. That'll tell you how to take advantage of the advisory service and how to get in contact with us. And then finally, to stay current on what's going on in Social Security, our socialsecurity.report.org it's an information-packed website. We update it every day. In fact, the 4 rotating editors are here in the room. Russ, Eileen, me, and Jeff in the back. But every morning you'll find a fresh slate of articles relevant to what's going on in Social Security. It's just a good way to stay abreast of what's going on. Same thing with the Medicare report, Medicare and healthcare. Every day there's articles posted on there. We channel information for you, and there's a lot of historical information, particularly on the Social Security side. The trustees' reports, for example, are accessible through our site, and there's just a wealth of information. It's a very active website. So, any questions? Russell.
It's not really a question, but Jerry reminded me of something in his comments, encouraging you to contact us if you have questions. But we do satisfaction surveys, and we're very, very proud of our satisfaction rate. We get a 98% satisfaction on the speed of our response, which is normally within basically a day, you have an answer. And we get a 96% satisfaction on the content, the quality of our response. And I think what we figured out is that other 4%, we have to tell them things that they don't want to hear. Okay, so just wanted to add that comment in.
Yeah, that's a good comment. We look seriously at everyone that doesn't respond positively, and invariably it's because they didn't like the answer we gave them, and there's just nothing we can do about that.
I just want to add one more thing. I know that we're running a lot of time here, but I always wanted to ask this little trivia question. We talk about people living longer, the baby boomers coming into the picture, adding to the strain on the trust funds and all that. But Social Security was enacted in 1935. First Social Security check went out in January 1940. Does anybody know who got that first Social Security check? You do? Really? You want to share it? Ida Mae Fuller. Wow. See, I told you these guys.
How much was it?
Just a little over $20 a month
Okay.
she was getting. At 62, okay, she was getting a reduced benefit. She died at 100. Did you know that? See? There. I'm telling you, these guys, I can't teach them anything.
I also know she contributed only slightly more than her monthly check.
She contributed
was
just
the
slightly
next
more
question.
than her monthly check. That's right.
Yeah.
The very first check she got. So anyhow, okay. Well,
I knew that.
you did know. Russ knows everyone. Okay, but thank you very much.
Are there any questions? And again, we're available anytime. Just check the website for how to contact us, and there's contact information out at the table. We take very seriously what we do, and those 28,000 counseling sessions, I tend to call them, are an indicator of how we progressed since we started this service in 2016. And it was something that our founder, Dan Weber, was really, really serious about. When we started this, his comment was, people really don't have any place to go if they don't understand what their decisions are or how they're going to impact them. And not knocking the field office of Social Security, but they're not really staffed or equipped to handle those kind of questions. So what's best for you? And so, that's what we focus on. So with that, I'll stop blabbering and thank you again.